Hello, everyone. Thank you so much for joining us today. As you're coming in the webinar room, we want to welcome you. My name is Marcia Butler. I'm the webinar director here at Advice Chaser. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. And let me go ahead and turn that feature on right now. Great. You should be able to chat with us. The presenter will answer those queries during or after the presentation today as appropriate. If you ask a question in the chat box, go ahead and leave your contact information as well. And if we're not able to get to your question during today's event, we'll make sure someone reaches out to you afterwards. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our presenter today. Kelly H. Clyde is a co-founding partner with South Coast Investment Advisors and a registered principal and elite advisor with Independent Financial Group. Kelly is a wealth manager that works primarily with rental real estate owners who want a clear look into their overall financial picture, guidance on how to best manage their liquid assets to complement their real estate holdings, and advice on how to ensure their portfolio is generating efficiencies to reduce annual tax burdens. He uses a broad spectrum of traditional and alternative asset classes and investment strategies to adapt portfolio allocations to the ever-changing economic landscape. Kelly is a certified financial planner. He graduated from the University of California, Santa Barbara with a BA in business economics and an emphasis in accounting. And Kelly, we're glad to have you here, and I'll turn the time over to you.
Wonderful. Thank you very much, Marcia, for having me once again. And thank you to everybody out there that's taken the time to join us today. I think we'll probably have to figure out a way to streamline that bio a little bit so it's not quite so wordy. But you hit on a key thing, the ever-changing landscape. And I think, that's obviously, more apparent now than really in some time. We've been living on low interest rates for the last 30 plus years, and finally that led to a significant amount of inflation and a huge about face with the Fed. And, it's a great time for you, those folks joining us today and whoever's watching this recorded in the future to kind of take stock of whether you want to keep doing the things the same way or, perhaps learn from what we'll call the smart money, which is institutional capital and what they're doing with their investment dollars. So how has the landscape changed? Last year, you could look at it and very clearly see that the whole idea of diversification in a traditional portfolio kind of went out the window. Equities were down, S&P 500 in the realm of 20 or so percent. Growth got clobbered. Value was a little bit better. But fixed income, which is supposed to be a safe haven in a storm, you look at the U.S. aggregate bond index and it delivered roughly a negative 11, 12% last year. And so if that's all the tools that you had in your toolbox, you probably had a pretty lousy experience. And so what we're going to try and talk to you today is why not look at the way that things have changed and created access for individual investors and take advantage of adding some of these tools that have been primarily used by institutions. And the last one is obviously so important. Even though last year was pretty nasty, we're not going to allow that to to be the determining factor about how we make investment decisions going forward. We don't drive our cars on the freeway, I hope, looking in the rearview mirror the entire time. We want to be looking forward, and that's how we should be managing our investments as well. So, the problems with a typical portfolio is that you are really limiting yourself with where your capital is being invested. The average moderate investor out there gets thrown into this 60% equity, 40% bond allocation. And there are years when that works. Last year was certainly not one of those. I actually argue that 40% of the portfolio that was in fixed income that was so disappointing, and quite honestly was disappointing for a long time because of low interest rates. And actually, I see opportunity in fixed income these days. There's just a lot of question marks about the other side of the portfolio, the 60% invested in stocks, and the potential for growth in what may end up ultimately being either a failure to have a soft landing, or potentially a mild recession, or maybe something worse. I mean, ultimately, my crystal ball is as fuzzy as everyone else's. So the idea is how can we bring in some alternatives in order to help really just enhance the investment experience over time. So I think this is my favorite slide of the deck. I'm not going to spend a ton of time on it, but I think it's very, very dramatic and very telling about the disparity between what most individual investors are doing and the changes that have taken place with institutional investors over the course of the last 30 plus years. And I want you to focus, because there's a lot going on here as far as all these colors, but just focus on the bottom two slices of the pie, the kind of grayish light blue and the blue just above it. So that's cash and fixed income on the bottom, and domestic equity, so U.S. equities just above it. And if you go back to 1990, institutional investors were not all that different from the average Joe. They had nearly 70% of their portfolios invested in basically stocks, bonds, and cash. But look, as time has shifted, how that has dramatically changed over the years, and how institutions have transitioned their portfolios into a variety of alternative investment sectors. And the answer, the question is why? And the answer there is they're looking for different sources of return to their portfolio. Depending on what type of institutional investor we're talking about, they have different agendas, different goals they have to provide. If it's a pension plan, they need to make sure that they have, capital to make those pension distributions on an annual basis. If it's an insurance company, they've got to meet, any kind of losses in terms of, casualties, whatever it might be. They have to make sure that they can pay those out, and they have a long time horizon. And so they have the ability to invest in things that tend to be less liquid than traditional stocks, bonds, and cash are, but can help reduce the overall volatility of their portfolio, which is ultimately their goal. They want to generate very stable, sustainable returns over time. And by introducing these other asset classes here, and we're certainly not going to go into all of these, it's really helped institutions basically satisfy what they need to do over time. So why are we talking about alternatives today? I think that the key is now, as a retail investor, we have access to a lot of these tools that we simply didn't previously, and a lot of that is based upon advancements in technology. For a long time, if you wanted to invest in private equity, hedge funds, venture capital, you had to be able to stroke a check for $10 million, $40 million, $50 million, $100 million. And unfortunately, I certainly couldn't do that. And even if you could, that might be too large of an egg in your basket. And so what's really been amazing is technological advances has allowed folks like us to invest in these areas of the market that have been previously, quote unquote, off limits, because now we can get in at more bite-sized investments, pieces at 25,000, 50,000. And so there's a lot more opportunity for investors to be looking at this space. And I think now is a great time to be doing so. So one of the first segments, and I think this is going to be an eye-opening statistic. When you hear about private equity, I mean, I'm sure that conjures up a lot of different thoughts. Probably Wall Street, pinstripe suits and pocket squares and so on and so forth. But the reality is, if you look at the companies in the United States that generate over $100 million of revenue on an annual basis, you're going to be shocked to hear that over 87% of those businesses, 87% are private. They are not public companies. One of the reasons why these companies stay private is because they can make decisions that may, in the short run, impair their profitability from one quarter to the next, but ultimately over the long term, just like the decisions that we're trying to make for our portfolios, they will better the company and make them more successful and more profitable. They don't have to satisfy the guidance of market analysts and so on and so forth every single 90 days. And so there's a lot of reasons to stay private. And there's been a lot more capital, as you've seen from that slide, from 1990 going forward, that's headed that way. In fact, I've got on my other monitor over here a slide that shows in North America and in Europe, the number of private equity-backed companies from 2011 was 6,200, and to 2021 was 22,000, over 22,000 private equity-backed companies. And you look at public companies in North America and Europe, basically flat over that same time horizon. So a lot of the money has moved in that direction. And up until very recently, as retail investors, we really haven't had the opportunity to go there. But as I've already said, there are a number of avenues to do that in your portfolio. So private debt is actually probably, outside of real estate, one of my favorite opportunity sets that we have access to today, or that we as investors, the folks on this call have access to. And I think you need to think about the idea of supply and demand. And with all of the noise that we're hearing about regional banks in crisis because they are losing deposits, well, those deposits are going somewhere. They're going to those mega banks, or they're going to direct lending institutions, funds that are designed to be an alternative capital provider. And so in the private debt realm, there's a huge opportunity to be originating debt to good quality companies that their previous sources of capital have basically dried up. Those banks, those regional banks can't provide those loans anymore because they have to strengthen their balance sheet or what have you, have more capital in reserve. And there's opportunities to originate debt with very strong lender covenants, meaning that the handcuffs that those borrowers are tied to are getting stronger and stronger. The yields on these loans, or the interest rate the borrowers are paying, have gone up dramatically over the course of the last 12 to 18 months as interest rates have risen. Additionally, many of the loans in the private credit space are written at floating rate. So there is a floor and a spread. And ultimately, if interest rates continue to rise, the cost to borrow will continue to go up to the borrower as well. So we have a bit of protection in terms of interest rate risk, which is one of the key risks when it comes to investing in fixed income. We also have the ability to decide what kind of collateral that borrower has that we are going to take in the event that something goes sideways. I like to think about it as being at a buffet, and there's a big long line of folks that are going to be eating from the buffet. And as a senior secured lender, which is one of the types of loans in this private credit space, we're the first one in line, and we ultimately get to decide when the food is dropped what we want to eat. And the guy that's at the end of the line, there might not be any food left for them. So if there is a credit issue and something goes south with that borrower, we are the first in line to get repaid. It doesn't mean that these are riskless investments, but it does mean that we have an increased security relative to traditional corporate level debt that you're buying on the public markets. Venture capital, I'll just touch on briefly. Really still something that is very challenging for most retail investors to invest in, because you're basically providing capital to growth stage companies to allow them to get to that another phase of existence. It's probably the highest risk component of the private markets, and one that you should tread lightly and do a tremendous amount of due diligence in terms of any of these, but certainly in venture capital. Hedge funds is a word I'm sure most of you have heard, but probably don't really have a full understanding of what it is that they do. They can be very, very complicated. And I'm not saying that hedge funds are going to be right for every investor, just like I can't say that any of these private strategies are going to be right for any investor. They do historically come with higher fees. I'm sure you've heard of a 2 and 20, and don't even know what that means, but it means 2% management fee and 20% of the profits. Basically, what a hedge fund is doing is they are looking at the market and they are deciding what they like, where they want to go long, meaning they want to invest for favorable outcomes. And they can also go short, meaning they can bet against certain segments of the market as well. And so there's an opportunity to generate returns that are not commensurate with what's going on in the public markets, because you can profit both as things are going up as well as other things going down. Real estate is an asset class that I love, in part because I'm a math guy, I'm a numbers guy, and when it comes to real estate, there's something tangible there where you can look to see, who are your tenants, how much are your tenants paying, what are the terms of their leases, are there rent growth, is there rent growth baked into those leases, is there not, so on and so forth. So a lot of my clients tend to gravitate toward it. Many of them have been, managing the terrible T's, the toilets and tenants and termites of property management themselves for decades. But ultimately, it's kind of the get rich really slow type place to invest in your portfolio. The great thing is today you don't have to go out and buy a duplex or a rental property on your own. There's a ton of avenues to invest in real estate in a passive format, where you're not investing in a publicly traded REIT or real estate investment trust. You can still get the benefits of private direct ownership. Picture private ownership of real estate as like an aircraft carrier, slow and steady, and public real estate has a tendency to be more like a speedboat that is going to be a little bit more nimble. It can move forward fast. It can also move back very, very quickly. And so when we look at adding real estate to your portfolio, this is kind of the best example of why have something like this. Last year, the private real estate index, the NCREIF index, delivered a 7% positive return, while equities were down 20-something and bonds were down 10% plus. A lot of my clients, having had exposure to private real estate, depending on what level of exposure they had, it helped either soften the blow or actually really provide positive returns. So something to consider, again, the why, in terms of why are we even talking about alternatives. Real estate and that experience last year delivered that. What I will say, though, is there's a lot of noise. There's noise about everything right now. There's noise about real estate. The pandemic really shifted the way that the office market is functioning. I am sitting in my office today. I'm not sure if Marche is in an office or if she's in a room at her house. But ultimately, it's changing a lot of things. And so it's important, when you talk about investing in real estate, that you drill down into, what am I really buying? What am I getting exposure to? I like apartments. I like self-storage. I like industrial. I like life sciences. I don't love big box retail right now. I don't love multi-tenant office right now, because there's just a lot of issues. Things are changing. And I would rather invest where the demographics are favorable. And so when considering an investment in real estate, again, think about, the nerdy guy in the glasses here, and think about the numbers, and think about the demand side of that. And that should help you drive in the right direction when it comes to figuring out how to invest in the real estate space. So there's opportunities to invest in commodities like oil and gas. There's basically kind of three different ways to slice the pie. You have upstream, which is the actual exploration and production companies like the Exxons and whatnot that are drilling the wells to find the hydrocarbons. There's midstream. There's master limited partnerships as a structure, kind of like a mutual fund that has exposure to infrastructure pipelines. These are like pipelines. It's like a toll taker on a toll road, where as the oil and gas passes through those pipelines, you're collecting a fee for that. And those types of vehicles can deliver nice returns in terms of cash flow. And then you have downstream, you have refiners. There's a number of other ways to invest there, but just understand, like many things, there's a lot of risk and volatility in things that we can't control in this market, like the price of oil and the price of natural gas, to the point that in 2020 for a day, if you had a barrel of oil, you had to pay somebody to take that barrel of oil off your hand. It didn't last very long. It was one day where oil was trading negatively. But ultimately, there are opportunities to invest in commodities like oil and gas to add something that tends to be more positively correlated to inflation. But just be sure you're really taking a look at how am I invested and what are my risks in this particular endeavor. So structured banking products are something that many of you may not have heard about. I just want to start by saying these are nothing new. These are products that are created by banks. Banks have been creating these for decades. It's just, again, through advancements in technology, the access for retail investors has improved dramatically. These are funds that have a defined time horizon, a defined return profile, and a defined set of risks. They are not for everybody. They tend to require a longer term investment cycle, 2 years, 3 years, 5 years, potentially 10 years. And investing in them, you should be willing to stay the course. Now, there is secondary market activity, meaning that if somebody gets into one, there's potential that they could get out of it prior to maturity. But you should invest in these, in any of these alternative investments. You should be willing to withstand the entirety of the business plan, however long that might take. But these tools are very, very popular right now, at least in my world, because they can deliver a return, whether it be cash flow or potential growth, even while a market index or an underlying company that these funds are tied to may not be performing all that positively. If they're going sideways or mildly lower or mildly positive, we can generate the potential to have that cash flow that is at a heightened level for most of these products, above and beyond what you can get from traditional income sources. So this is probably my second favorite slide relative to the first one that talked about the changing allocations of institutions. This goes to due diligence. And this is really where the rubber meets the road. Is if you look starting on the left-hand side there, you can see that gray bar in terms of global equities. What you have is the disparity between the top 25%, the top quartile managers and their returns, versus the bottom 25%. And it's kind of one of those things where you could be great, you could be the best, you could be the worst, and you're probably not going to see that much variation in terms of return. Same thing with global bonds, same thing with core US real estate. There's not a dramatic disparity. Ultimately, it's all about just being invested. And what we like to do in my practice is look for ways to be invested very inexpensively. Let's try and find ways to get broad-based exposure without having to pay an arm and a leg for it. Now, when you start to move out to the right of this slide and you look at non-core real estate, global private equity, venture capital, and hedge funds, you can see the disparity between the best managers and the worst managers is very significant. And that's where it really pays to do your due diligence, but also work with advisors that are actively conducting their own due diligence as well. because I don't want to be working with the guy that's working out of the back of a van and has only been doing this for a short while and is just basically throwing darts at a dartboard. I want to see a tried and true process that is repeatable before I decide to allocate capital in that direction. And so it's incredibly imperative to understand the process that these managers are using before you go down the path of any of these alternative investment sectors. So next steps is really to take stock, and it's not written here, but many of these things that I've talked about are alternatives because they lack the liquidity that comes with investments in the public markets. You invest in a stock today, you don't even have to wait till tomorrow to sell it. You could sell it as long as the market is still open. I heard Robinhood is going to avail investors to the opportunity to start trading a certain number of equities all throughout the day, 5 days a week. And when we talk about alternatives, one of the big differentiating factors is that in many instances, they are not liquid. They are designed to be held in your portfolio like the aircraft carrier that is moving slowly in its own direction, right? It's not being pushed around like a sailboat where the winds might be at your back at one point and pushing in your face the next. So the first thing you need to do is evaluate your ability to sustain some element of illiquidity in your portfolio. Maybe it's 2%, maybe it's 5%. I certainly wouldn't recommend anyone look at having more than 30% of their portfolio invested in illiquid alternatives. But again, that's for you and your advisor to ultimately determine. But to kind of pull this together, now is a great time to look at bringing in a professional and to take stock of where you are, because as we talked about at the outset, the playbook needs to change. The environment around us has changed dramatically. We have the Fed basically trying to walk a tightrope and take the air out of a very, very substantial bubble that was created for a variety of different forces. And I think that if you continue to do things the way that you've done them, you'll likely be disappointed. And so now is a great time to kind of take stock of where you are, what you want to accomplish, and look at potentially making some changes to incorporate how the world has changed around us.
All right. Well, thank you for that. We're going to go ahead and open up the floor for questions now. And I have a few questions to start us out. To our attendees, go ahead and put any comments or questions you have in the chat that's open for you. You talked about opportunities for fixed income. Can you talk a little bit about that? That was something you mentioned at the beginning.
Sure. I've been a financial advisor since 2004. And it wasn't until about 8 months ago, that I ever placed a U.S. Treasury trade. And the reason why is because there was no juice to be squeezed, right? And so as the Fed has dramatically increased rates from 0 to a target Fed funds rate of 5 to 5.25, that's driven prevailing market interest rates higher. And I would say that there are opportunities to invest in traditional fixed income. That is the stuff that is traded, publicly available. I just happen to think that one of the biggest opportunities in the market today is looking at being a direct originator of loans. And that tends to be in a format like an interval fund, which has quarterly liquidity as opposed to daily liquidity. But you need to be looking at fixed income. You need to be looking at the creditworthiness of your borrowers. They talk about high yield bonds, and that's another way of saying junk bonds. That's lower than investment grade. Those bonds tend to have a correlation to equities and the economy. And if we see a downturn in the economy and a downturn in equities, you may see the value of those bonds going down because of the concern about the creditworthiness of those borrowers. You also need to be looking at duration. When you are building a portfolio. Right now, things are very, very weird over the next month or two because of the debt ceiling debacle that's going on in Washington. So there's a lot of different lenses that you need to be looking at. But I would argue that because of the capital constraints, again, think about just supply and demand dynamics. There is a lack of supply. There continues to be a very significant amount of demand from very credible borrowers. And so there's opportunities to be an originator of debt where you get to name your terms with a lot more teeth than what we had seen in years past.
And speaking about debt, the question is, what sort of entities allow you to invest in this private debt? Are these companies? Are these funds? What kind of entities are you looking at?
Sure. So there's a structure called a business development company, or a BDC. They are, generally speaking, middle market lenders. They are lenders to private companies, or they're lenders to public companies, but they're directly originating those loans. There are interval funds also that have the ability to invest across the entire spectrum, both public credit and private credit. So there are different tools of investing in these types of vehicles. And then there are funds, long-term, 5 to 10 year hold funds, like a private equity fund, but they have a private debt mission to them. So there's different ways of going about it. I kind of have to hedge my words there because I know I'm not supposed to talk about specific product providers. But there are, I would say, business development companies are the primary tool in terms of those that are originating debt in this environment today.
All right. You talked a little bit about REITs, and you talked about, commercial versus residential. What kind of due diligence do you need to do if you're interested in REITs in order to pick the right investment for that?
Well, the first thing is to understand what it is that they're investing in, and also understand, as best you can, when they were buying the stuff that they were buying. There's a big difference between a portfolio that may have been around for 30 years and has been buying and maturing and selling and buying and maturing and selling assets over an extended period of time, versus a REIT or a fund or what have you that may have been launched at a poor time and buying at the peak of the market or something along those lines. So the key is just simply looking at what it is they own, how long have they buying, when were they buying. You need to look at their debt structure. There is going to be some issues in terms of refinancing the debt that's outstanding on office buildings. Unfortunately, you could have an amazing office building today, but as the environment for office has unfortunately worsened, the value of your asset through no fault of your own may be lower. And if you have a loan coming due, just like a mortgage on your house, if you went to go refinance and you thought your house was worth $1 million, and it turns out the appraisal is only $800,000, the lender may not be willing to replace the entirety of your loan. So again, you need to know or focus on, what does that REIT own, or what does that private real estate fund own? When were they buying? What were they buying? And how much leverage do they use?
All right. Another question about liquidity. The question was, obviously, there's not a stock market for selling alternatives. What kind of market is there if you want to get out of the investment, say before that time frame has elapsed?
It really just boils down to what type of alternative investment product you're investing in. I've made reference to a structure called an interval fund. An interval fund is like a mutual fund. It's got the ticker symbol. You can look it up every single day. The share price updates every day. You can invest in it every single day, but there's 1 day per quarter where you can hit the exit, where you can call your advisor and ask them to place the trade to redeem your shares. There are gates. Typically, it's 5% of the outstanding shares in any one quarter. So you may not get all of your shares bought back in any 1 month. So it may take time to get out. There are private real estate funds that have a 3 to 5 year time horizon. Like, we have access to real estate development funds. We work with a company that is building multifamily assets. Unfortunately, there really isn't a market to go ahead and sell between when the capital is raised and when the property's been built, it's been leased up, they have tenants, and they're selling that to a buyer of stabilized multifamily. You should look at it as something that's going to be with you. Now, with all of that said, there are firms out there, Central Traded Transfer is one that just pops into my head, that are creating or attempting to create a secondary market in these types of products. But from those that are intended to be very illiquid for a long period of time to interval funds where you have illiquidity but access every single 90 days, there's a lot of variation in between. So it's not just that every product is illiquid for a long time or every product we have access to. There's different structures in this field of alternatives that may allow you more accessibility versus those that may not be right for you because of that time horizon. You know, if you're an 8-year-old investor, alternatives may make sense, but investing in private equity that has a 10-year lockup may not be right for you unless, you know, you're not investing for yourself, you're investing for your family, and your family's on board with that type of time horizon.
Very interesting. And I know you mentioned this, but the question came in again. Just can you talk a little bit about maybe the investing philosophy behind a percentage that you would put in alternatives like these, as opposed to, you know, the stocks and bonds? Can you talk about that philosophy there?
Yeah, I mean, ultimately it boils down to your need for liquidity and your goals. You know, if you're somebody that is looking to buy a home in 2 years' time, we certainly can't take that would down payment and lock it up in a 10-year private equity fund, right? And so it's kind of a nuance. You know, I said it depends is basically the answer to the question, which is the non-answer. But it really depends on personal circumstance and how much of your portfolio you can put into something that you can't get out of in a moment's notice. I mean, think about if you're an investor that's reaching the age where you're forced to take required minimum distributions from your retirement accounts. We certainly can't, you know, put a large sum via like a percentage into an illiquid product, because ultimately you're going to be forced to, even if you don't want to, the IRS is going to force you to take withdrawals from that account. So there's a lot of different factors that go into what the percentage is. I think ultimately it really boils down to, again, your need for liquidity, and then also kind of the education. You know, these are different vehicles. They kind of march to their own drummer, and you need to take the time to educate yourself on best case scenario, worst case scenario, kind of in between, so that you're not jolted by the experience along the way.
All right. Well, thank you so much for that. That's about all the time we have for questions today. I want to thank the organizations that have made this webinar possible today. Thank you, Kelly, for providing your expertise and perspective on this topic. On behalf of Advice Chaser, thank you so much to our attendees, and look to an email soon with a link to the replay of this event. You're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again, from Advice Chaser, thank you everyone for coming, and we hope to see you at another webinar soon. Goodbye, everyone.